welcome to our deep dive, into the intelligent investor. A classic.
Oh, yeah.
Like, we're talking a real investing Bible here.
Absolutely.
You guys send in some excerpts, and we're going to, really try to pull out those core principles for success in investing, especially, given today's crazy market.
Yeah.
It's wild to think about Graham's track record, though.
Oh, yeah.
I mean, the guy consistently beat the market
Right.
by like 5% every year for 20 years.
Amazing.
And on top of that, he mentored Warren Buffett.
I mean, talk about a legacy, right? Buffett himself always says how much Graham shaped his approach.
Okay, so let's jump into this legendary book.
Yeah.
One of the first things that really stood out to me in those excerpts he sent was the difference between an investor and a speculator. It seems so crucial, especially today when it feels like everyone's chasing, the next hot stock.
Right.
Just hoping to get rich quick.
Yeah, Graham really hammers home that distinction.
Okay.
He says an investor focuses on the intrinsic value of a business. Their patient discipline, looking for long-term returns.
Makes sense.
But a speculator, they're all about those short-term price swings, driven by emotions and, whatever the market trend of the day is.
So it's almost like they're gambling.
Right. Yeah, basically. Just hoping to get lucky with a quick price move.
And Graham's saying that's not investing. That's
Uh-huh.
just, speculation.
Exactly. And he argues that understanding this difference is fundamental to everything else in the book.
Got it.
It's like step one before you even think about making a financial decision.
So how can I, practically use this idea in my own decisions?
Okay.
Let's say I'm looking at a company. How do I know if I'm being an investor or falling into that speculation trap?
That's a great question.
Yeah.
One key is to really look beyond the hype. All the excitement surrounding a company or an asset. Ask yourself, am I truly interested in the fundamentals of this business?
Right.
Or am I just, hoping to ride a wave of market sentiment for a quick buck?
I see what you mean. Like, am I actually digging into the company's financials, their earnings, their management team?
Exactly.
Or am I just, basing my decision on rumors or what I see trending on social media?
Right. An investor digs into the facts. They analyze the information. A speculator, well, they often just go with their gut or follow the crowd.
So it's about taking a step back and being honest with myself about why I'm interested in this investment.
Exactly. That self-awareness is key.
Okay, that's super helpful. So we've got this crucial difference between investor and speculator. Now what?
Well, now Graham lays out the 3 core principles of intelligent investing.
Okay, lay on me.
He calls these the cornerstones.
Cornerstones. All right, I'm ready to build my investing foundation here.
Great. So
Yeah.
the first cornerstone is the margin of safety.
Margin of safety.
This basically means buying assets for significantly less than their intrinsic value.
Yeah.
You're creating a buffer against those inevitable market fluctuations.
Right.
Or even, your own errors in judgment. We all make them.
So even if I make a mistake or, the market takes a sudden dip, I've got some cushion built in.
That's the idea. The second cornerstone is understanding Mr. Market.
Okay, Mr. Market.
Now, this is where Graham gets really clever.
Right.
He personifies the market as this emotional entity who's always offering you a price to buy or sell your investments.
Interesting. So it's like he's this unpredictable character who can be happy one day and totally depressed the next.
Right. And Graham says the key is to not let Mr. Market's moods dictate your actions.
So don't let his emotional roller coaster influence your rational decisions.
Precisely. You need to stay level-headed even when Mr. Market's going crazy.
Got it. What's the third cornerstone?
The third one is know thyself.
Know thyself.
Sounds philosophical, right?
It does.
But Graham is emphasizing the importance of really understanding your own risk tolerance, your time horizon for investing, and your overall financial goals.
So aligning your investment approach with your own personal circumstances.
Exactly. It's about being honest with yourself about what you're comfortable with and what you're aiming to achieve.
Okay, so we've got the investor versus speculator distinction and these 3 cornerstones: margin of safety, Mr. Market, and know thyself.
You got it. Those are the foundations.
Now, how does Graham suggest we actually put these principles into practice? What are the different approaches we can take?
Well, Graham outlines 2 main paths, the defensive investor and the enterprising investor.
2 paths.
Okay.
Let's start with the defensive investor.
Sure.
Who is this approach best suited for? And what are the key characteristics?
The defensive investor is all about stability and minimizing risk.
Okay.
It's a steady, reliable approach, perfect for those who want a less hands-on experience.
So someone who values peace of mind over
Sure.
maybe higher but riskier returns.
Exactly. They're more focused on preserving capital and generating consistent income.
Makes sense.
Typically, they'll focus on a diversified portfolio of large, well-established companies. And high-grade bonds, they're big on consistent saving, long-term holding, and avoiding the temptation to time the market.
It sounds like a more hands-off, set it and forget it kind of approach.
Yeah, you could say that. And Graham even provides specific criteria for choosing stocks for a defensive investor.
Really? So it's not just picking any big-name company?
No, he emphasizes factors like financial strength, consistent dividend history, and a moderate price relative to earnings and assets.
Okay, so there's still a level of analysis involved, even for a more passive approach.
Definitely. Now, in contrast to the defensive investor, we have the enterprising investor.
Okay, the enterprising investor. This is where things get a little more active.
You could say that this path is for investors who are willing to put in more time and effort to potentially achieve higher returns.
So what does it take to be an enterprising investor? What kind of qualities are we talking about?
Well, first of all, an enterprising investor needs a solid grasp of financial analysis.
Okay, so some number crunching skills are required.
Yeah, they need to be comfortable digging into a company's financials, understanding their business model, and really assessing their competitive position.
Sounds pretty intense.
It can be. And maybe most importantly, an enterprising investor needs patience.
Patience?
And the ability to resist getting caught up in the hype of those hot stocks everyone's chasing.
So staying disciplined even when the market's going wild.
Exactly. Graham's really upfront about the challenges, though.
Okay.
He warns that succeeding as an enterprising investor takes serious dedication.
Yeah.
Deep knowledge of financial analysis, a long-term perspective, and the discipline to stick to your strategy even when things get turbulent.
So it's not for the faint of heart.
Definitely not. But he also shows how it can be incredibly rewarding.
Okay.
He shares the story of his own investment partnership and how they achieved amazing returns.
Really?
Yeah, all through careful analysis and finding those undervalued companies that others were overlooking.
So he's saying real success comes from knowledge and discipline.
Yeah. Exactly. Not from chasing quick riches or, getting caught up in the latest fad.
That's a powerful message.
Wow.
So we've got these two paths, the defensive and the enterprising. But how do these principles hold up in today's market?
Right.
I mean, the landscape has changed so much since Graham's time.
Mm-hmm.
We've got online trading algorithms, so much information at our fingertips. Does his wisdom still apply?
That's a great question, and it's something we'll definitely delve into in the next part of our deep dive.
Okay, I'm hooked. Let's explore how Graham's timeless principles hold up in today's crazy complex market.
Sounds good. Yeah, you're absolutely right. I mean, the market today is like a completely different beast compared to Graham's time.
Right.
But here's the thing. His core principles, they're still incredibly relevant.
Okay.
In fact, I'd argue they're even more important now.
Why is that?
Because today we're bombarded with information,
Right.
It's so easy to get swept up in trends and all the hype.
Yeah, it's like information overload sometimes.
Totally. So let's think about Mr. Market again.
Okay, Mr. Mark.
Remember Graham's analogy of the market as this emotional being,
Right. Swinging from like super optimistic to totally dim and gloom.
Exactly. And instead of letting his crazy moods control us, we're supposed to use them to our advantage.
I get that in theory.
Yeah.
But how do I actually spot Mr. Market's moods in today's market?
Good question. It's about looking beyond, those attention-grabbing headlines and all the noise.
Okay.
For example, think about those stocks that everyone's suddenly raving about. Prices are skyrocketing, but is it based on solid fundamentals? Or is it just pure speculation? That might be Mr. Market getting a little too enthusiastic.
I see. So like the opposite could be true too, right?
Yeah.
Like a solid company with good financials, but it's being ignored or punished because of some short-term market dip or bad news.
Exactly. That could be Mr. Market being irrationally pessimistic.
So it's about recognizing those times when the market sentiment doesn't match the actual value of the business.
That's it. But that's tough.
Yeah, with all this information flying around, it feels overwhelming sometimes.
It definitely takes effort and discipline.
Okay.
You have to develop your own judgment, do your own research, and not just get swayed by, every opinion or prediction out there.
Speaking of predictions, Graham seemed pretty skeptical of anyone who claimed to know what the market would do.
Oh, absolutely. He believed that even the so-called experts have a terrible track record.
Really?
Oh, yeah. He said trying to predict market movements is basically a fool's game. And even when those predictions are right, it's often just dumb luck, not skill.
So should we just ignore all market forecasts and trends then?
Not necessarily. I mean, it's helpful to be aware of those broader economic trends and market cycles.
Right, like knowing what a bull market versus a bear market looks like.
Exactly. But Graham's point was this: trying to time the market perfectly, buying at the absolute bottom and selling at the peak.
Yeah.
Well, it's pretty much impossible
Okay.
and often leads to costly mistakes.
So it's more about understanding those larger cycles and not trying to outsmart the market with, those short-term bets.
That's it. Focus on the long game.
Got it. Now, we've talked about Mr. Market and predictions, but what about diversification?
Ah, diversification. That's a
Yeah.
classic.
Right, the old don't put all your eggs in one basket advice.
Exactly. But Graham took it a step further.
Okay, how so?
He saw diversification as a crucial risk management tool.
Okay.
He said no matter how carefully you pick your stocks, there's always a chance that something unexpected happens. Some unforeseen event that impacts a particular company or industry.
Like what kind of event?
It could be anything, really. A sudden shift in consumer tastes, new regulations, disruptive technology, even natural disasters.
Yeah, you can't predict everything.
Exactly. And that's where diversification comes in.
Okay.
By spreading your investments across different companies, industries, even different types of assets, you're basically reducing the impact of any one investment on your overall portfolio.
So you're creating a safety net.
Exactly.
Sure.
You're not putting all your eggs in one basket and hoping for the best.
So how much diversification did Graham actually recommend?
Well, he suggested aiming for a portfolio between 10 and 30 different stocks.
Okay.
He believed that range offered a good balance, not too concentrated, but also not so spread out that you can't keep track of everything.
Right, that makes sense. And he wasn't just talking about stocks, right?
No, he emphasized diversifying across asset classes, too.
Okay.
So not just stocks, but also bonds, real estate, even things like commodities.
So you're building a portfolio that can handle different market conditions.
Exactly. You're not betting on just one horse to win the race.
Now let's talk about picking individual stocks.
Okay.
Especially for those enterprising investors who are willing to dig deeper. I know Graham had some pretty specific criteria.
He did. For those who are comfortable with financial analysis, Graham outlined 7 key factors to look for.
7. Okay, give me the rundown.
All right, so the first one is adequate size of the enterprise.
Okay, adequate size.
He preferred companies that had a certain scale, measured by things like their market capitalization or annual sales.
So bigger companies are generally better.
Well, he believed larger companies tended to be more stable,
Okay,
less susceptible to those extreme swings that smaller companies might experience.
makes sense.
The second factor is a sufficiently strong financial condition.
All right, so looking at their balance sheet.
Exactly.
Hmm.
Are they in a healthy financial position? Do they have manageable debt? Strong liquidity. These are all crucial for a long-term stability.
Got it. What's number 3?
Number 3 is earnings stability.
Earnings stability.
Graham looked for companies with a consistent track record of earnings,
Okay.
ideally over the past 10 years. This shows they're consistently profitable, not just, having one good year by chance.
So a proven track record?
Right. Then there's dividend record.
Dividend.
He liked companies that had a history of paying dividends.
Okay.
This
yeah.
indicates they're generating profits and sharing them with their shareholders.
Makes sense. What about growth? Did Graham care about a company's growth potential?
He did. For enterprising investors seeking higher returns, a reasonable rate of earnings growth was definitely a plus.
Okay.
After all, a company that's growing its earnings is more likely to see its stock price go up over time.
Right. So growth is important, but it's not the only factor.
Exactly. Now, the next 3 criteria are all about valuation.
Valuation.
The first one is a moderate price-to-earnings ratio.
Price to earnings or PE ratio.
Right. This compares the company's stock price to its earnings per share.
Mm-hmm.
Graham believed that stocks with lower P/E ratios offered a greater margin of safety.
Okay.
They were more likely to be undervalued by the market.
So it's like getting a better deal.
Exactly. Then there's a moderate ratio of price to assets.
Price to assets.
This is another way to look at whether a company's stock is trading below the value of its assets.
Okay.
He liked companies with a low price-to-book ratio, as this suggested they might be undervalued.
So kind of like buying $1 for 50 cents?
Yeah, sort of. The key takeaway here is that Graham wasn't just about finding cheap stocks. He was emphasizing thorough financial analysis and finding companies with solid underlying value.
And with so much information out there today, it's easy to get lost in the noise.
It is. But Graham's emphasis on critical thinking and independent analysis is more crucial than ever.
Now, we talked about stocks, but I know Graham also had thoughts on bonds, preferred stocks, warrants, and convertible bonds.
Yeah, he did. He saw bonds as an important part of a balanced portfolio,
Okay.
especially for those defensive investors seeking stability and income.
Makes sense.
Uh,
But he wasn't as keen on preferred stocks.
not really. He considered them a bit of a mixed bag.
Why is that?
Well, they offer some features of both stocks and bonds, but Graham felt they often didn't strike a good balance between risk and reward.
Okay.
And then there were warrants. He actually called them a near fraud in his book.
Wow, strong words. What made him so against warrants?
Well, they can be highly speculative, and he felt they often created this illusion of value,
Well,
leading investors to overpay for the underlying security. He was much more cautious about convertible bonds.
convertible bonds.
Yeah, he saw them as having some potential, but stressed the importance of analyzing those conversion terms and the underlying value of the company's stock.
So even with these more complex instruments, his focus was always on understanding the true value.
Absolutely. And that's really the essence of Graham's approach.
It's about making informed decisions based on solid analysis, not getting caught up in hype or speculation.
Exactly. And in the final part of our deep dive, we'll explore Graham's insights into these other investment types and see how they fit into his overall philosophy of intelligent investing.
All right, so we've covered, those core principles, the different approaches to investing and stock selection.
Right.
Now let's dive into some of the other investment avenues that Graham talked about. Starting with bonds. How did he view bonds, as part of a well-rounded portfolio?
Graham was a big believer in bonds,
Okay.
especially for those defensive investors,
Wow.
the ones who are really prioritizing stability and income. He particularly liked those high-grade bonds issued by, financially strong companies or governments because those offered a lower risk of default.
So bonds are more about preserving your money and getting that steady income stream.
Yeah, as opposed to, potential for big growth that you might seek from stocks.
Right. So it's like a different kind of investment goal.
Exactly. And Graham believed that bonds played a crucial role in balancing out a portfolio.
Okay.
They help smooth out those returns, and reduce the overall risk.
Because stocks can be so volatile sometimes.
Oh, absolutely. He even suggested a formula for figuring out that ideal balance between stocks and bonds.
A formula. Okay, I'm intrigued. Tell me more.
He said that investors should never have less than 25% of their money in stocks,
Okay.
or more than 75%, and the same goes for bonds.
So your bond allocation should be somewhere between 25% and 75%.
Right, depending on your overall strategy.
Oh, yeah.
He actually saw a 50-50 split as a good starting point for most investors.
Okay, so half in stocks, half in bonds.
As a general rule of thumb,
Right.
But he also recognized that there are times when it makes sense to adjust that allocation.
Okay. Like what?
For example, you might increase your bond holdings during those periods of high market volatility.
Right, when things are a bit shaky.
Yeah. Or you could decrease your bond allocation when the economy's strong and interest rates are low.
So you're being a bit more strategic with how you balance those two.
Exactly. It's not about rigidly sticking to a certain percentage, but using it as a framework, to think about your overall portfolio.
That makes sense. Now, when it comes to actually choosing specific bonds, what did Graham emphasize?
Well, creditworthiness was a big one.
Creditworthiness.
That's basically a company's ability to pay back its debts,
Right.
He preferred bonds with high credit ratings,
Okay.
issued by companies with a strong track record of profits and, a stable financial situation.
Yeah, you want to be confident that they're actually going to pay you back.
Exactly. And Graham also understood how interest rates can impact bond prices.
Okay. Interest rates?
He knew that when interest rates go up, bond prices tend to go down and vice versa.
Right. It was like an inverse relationship.
Exactly. So he wanted investors to be aware of that, and to consider the potential for interest rate changes when they're making bond investments.
So even with bonds, there's a level of risk to consider.
Yeah, there's always some level of risk, but bonds generally offer more stability and income than stocks.
Okay. That makes sense. Now, I know Graham wasn't as enthusiastic about preferred stocks.
Yeah, he was a little skeptical of those.
Why was that? What was his issue with preferred stocks?
Well, preferred stocks are kind of like a hybrid. They have characteristics of both stocks and bonds. They typically pay a fixed dividend like a bond,
Okay.
but they also represent ownership in a company, like a common stock.
But they don't usually have voting rights.
Right, usually not.
Yeah.
And those dividends aren't guaranteed either.
Okay.
A company could reduce or even skip those payments if their financials take a hit.
So they're kind of stuck in the middle.
Yeah, that's a good way to put it. Graham felt that they often didn't offer a satisfactory balance of risk and reward.
I see. So not enough growth potential and not enough security.
Right. Unless they were offered at a really steep discount, he'd probably advise steering clear.
Okay, so be wary of preferred stocks. Now, Graham was really outspoken about warrants.
Oh, yeah. He did not like warrants.
I think he even called them a near fraud in his book.
He did. He saw them as highly speculative.
Why was that? What made him so against warrants?
So warrants are basically options that give you the right to buy a company stock at a certain price within a specific time frame.
Okay.
They're often issued alongside bonds or preferred stock to make those securities more attractive, you know.
So it's like a little bonus feature.
Yeah, but Graham felt that they created this illusion of value,
Okay.
tempting investors to overpay for the underlying security.
So they're not all they're cracked up to be.
Not according to Graham. He also argued that warrants could actually dilute the ownership of existing shareholders.
Okay, how so?
Because those warrant holders, they could potentially buy shares at a discounted price later on.
I see. So that could negatively impact the value of those existing shares.
Right. He basically felt that warrants were more beneficial to the companies issuing them than to the investors buying them.
So he was urging caution.
Big time.
Yeah.
He said, if you're going to consider warrants, make sure you really understand the risks.
Okay. Now, what about convertible bonds? Those seem a bit more complex.
Yeah, convertible bonds are essentially bonds that can be converted into the company's stock at the bondholder's discretion.
So you have the option to convert them into stock.
Exactly. So you have the potential for both fixed income from the bond and the possibility of capital appreciation if that stock price goes up.
So it's like a 2-for-1 deal?
Yeah, kind of. But Graham, being Graham, he also urged caution.
Okay, of course.
He said to really scrutinize those conversion terms and the underlying value of the company's stock.
Right. Do your due diligence.
Exactly. He pointed out that convertible bonds often have lower interest rates than regular bonds.
Okay, why is that?
Because investors are willing to accept that lower yield in exchange for that conversion option.
Yeah.
You know?
Oh, I see.
So he said, make sure that potential for stock price growth actually makes up for that lower interest income.
So you're weighing those trade-offs carefully.
Right. He also warned that that conversion feature could tempt people to make irrational decisions.
Okay.
Based on the stock price, rather than the true value of the company.
So getting caught up in the hype again.
Exactly. He believed convertible bonds were best suited for investors who were comfortable with both bonds and stocks and who had the knowledge and discipline to make those rational decisions based on solid analysis.
It seems like a big takeaway from Graham is this emphasis on really doing your research.
Oh, yeah, absolutely. He's all about thinking independently, not just blindly following the crowd.
Right, thinking for yourself.
Exactly, and not getting swept up in all the market hype.
So intelligent investing, it's about making informed decisions based on a solid understanding of value,
Yes.
of risk, and of your own financial goals.
You got it. It's about tuning out all that noise and focusing on the fundamentals.
We've covered so much ground in this deep dive.
We have.
It's been a real journey through The Intelligent Investor.
Yes.
I feel like I have a whole new perspective on investing now.
Well, that's great to hear. Any final words of wisdom for our listeners as they, set off on their own investing journeys?
Yeah, what are some key things to remember?
Here's what I'd say. First, be wary of Mr. Market's mood swings.
Okay, Mr. Market, those mood swings.
Don't let your emotions drive your decisions. Focus on the intrinsic value of those businesses you own.
Right. Look beyond the hype.
Exactly. Second, diversify your portfolio strategically.
Diversification.
Spread your investments. Don't put all your eggs in one basket.
Good.
Third, always do your homework.
Do your homework.
Research those companies thoroughly before you invest. Understand their financials, their management, their competitive landscape, everything.
It's all about being informed.
Right. And fourth, patience and discipline are key.
Patience and discipline.
Investing is a long-term game. Don't try to get rich quick or chase those speculative bubbles that always burst eventually.
Stay the course.
Exactly. And finally, know yourself.
Know yourself.
Understand your risk tolerance, your time horizon, your financial goals. Make decisions that align with your own personal circumstances.
This has been such an insightful exploration of The Intelligent Investor.
I'm glad you enjoyed it.
I feel so much more prepared to approach investing with confidence now.
That's what we like to hear.
Thank you for being our guide on this deep dive.
My pleasure. And remember, Graham's principles are timeless, but applying them in today's market takes, continuous learning.
Right.
Adapting to those changes and always staying informed.
That's a great reminder. And to all our listeners out there, best of luck on your journey to becoming intelligent investors.
Cheers to that.